Elena has a €200,000 ETF portfolio. She needs €50,000 for a renovation. She could sell, but she doesn't. Instead, she borrows it at 2.5% while her portfolio keeps compounding. She just used something called a Lombard loan, and most ETF investors have no idea they can do this. You do not have to sell your portfolio to access its value. Most investors never knew they had this option. This is what NTM told us, the technical layer behind the philosophy. Chapter 1. What a Lombard loan actually is. A Lombard loan, named after the Lombard Street banking district in London and used by wealthy European investors for over a century, is a loan secured against financial assets. Your ETF portfolio, your bond holdings, your stock positions serve as collateral. The bank lends you a percentage of that value at an interest rate far below an unsecured personal loan. In Elena's case, her €200,000 ETF portfolio gives her access to approximately €100,000 to €140,000 in borrowing capacity, typically 50 to 70% of eligible holdings. She draws €50,000. She pays interest monthly. Her ETF holdings stay in the market, continuing to compound. This is the mechanics of a Lombard loan in one sentence. You access the value of your portfolio without triggering a sale, a tax event, or an exit from the market. European platforms now offering Lombard facilities to retail investors include interactive brokers, whose margin rates for portfolios above €100,000 can be as low as 1 to 2% above the ECB base rate, and Saxo Bank. This product has existed for decades in private banking. It is only recently accessible to ordinary investors. If this concept is new to you, you are not alone. Most ETF investors have never heard of a Lombard loan. Stick around for the numbers. Psychology: sell versus borrow. Now that you have seen the tool, here is the mistake most investors make instead. When they need liquidity, they sell. The market is up, they need €20,000, so they sell some ETF units. The investment is gone. The compounding stops on that portion, and in the years that follow, they miss the growth on the portion they exited. This is the liquidity illusion. The portfolio feels liquid because it can be sold. But liquid does not mean selling is the right choice. A Lombard loan converts liquidity into an option without exercising it. Chapter 2. The Arbitrage Math. The case for a Lombard loan rests on one piece of arithmetic. If your ETF portfolio returns more than the Lombard loan costs you, borrowing against it is mathematically rational. Elena borrows €50,000 at 2.5% annual interest. Her annual interest cost €1,250. She uses the €50,000 for her renovation, freeing her portfolio to keep compounding at 8% historical average return, according to Vanguard's long-term return research. Her €200,000 portfolio generates approximately €16,000 in the first year at 8%. Her interest cost €1,250. She keeps €14,750 of the return. Now Marc. Marc takes a €50,000 personal loan at 6.5% for the same renovation. His annual interest cost €3,250. His portfolio is not touched, but it was already smaller because he never built one aggressively. Net, negative €3,250 per year until repaid. Elena pays €1,250 a year to keep her entire portfolio compounding. Marc pays €3,250 a year to keep his smaller. Same renovation, same amount borrowed, completely different financial outcome. The condition that makes the Lombard loan work: the expected portfolio return must consistently exceed the loan interest rate. At current ECB rates and typical Lombard loan pricing, this condition is met for a broad global ETF portfolio, historically returning 7 to 10% per year. If the arbitrage math is landing, hit like. It helps more people find exactly this kind of breakdown. Chapter 3. The Risk, Thomas and the Margin Call. Now the cautionary tale. Because the Lombard loan arbitrage only works when the math holds, and markets do not always cooperate, Thomas has a €200,000 ETF portfolio. He uses a margin investing account, a specific type of Lombard facility used to buy more investments, to borrow 100,000 euros. His total invested, 300,000 euros. The market drops 40%. His portfolio falls from 300,000 euros to 180,000 euros. His Lombard loan is still 100,000 euros. His broker issues a margin call. The loan-to-value ratio has breached the limit. Thomas must immediately reduce the loan or deposit more cash. Thomas has no spare cash. He is forced to sell ETF units at exactly the worst moment, at the bottom of the crash, to repay the Lombard loan. He crystallizes the loss. He exits the recovery. Thomas did not lose money because the market crashed. He lost money because the margin call forced him to sell at the bottom. The Lombard loan turned a temporary fall into a permanent loss. This is sequence of returns risk applied to leverage, covered in episode 11 of What NTM Told Us. The same crash without leverage is survivable. With 50% leverage, it is catastrophic. The safety rules: never borrow more than 20 to 25% of portfolio value on a Lombard loan. Keep a cash buffer of 1 to 2 years of interest payments. The Lombard loan is the tool. Over-leverage is the mistake. Chapter 4. Mike's 3-question framework. On Nobody Told Mike, Mike Petry uses a 3-question framework for every debt decision, covered in his debt trap video, link in the description, applied to a Lombard loan. Question 1. Does the asset grow in value? A broad global ETF, VWCE, VUSA, has historically returned 7 to 10% per year. Yes. Question 2. Is the Lombard loan interest rate below the expected return? At 2 to 3% against a portfolio returning 8% historically? Yes. The spread is positive. Question 3. Can the asset service the Lombard loan itself? This is where most strategies require honest scrutiny. A VWCE accumulating ETF does not pay dividends. The portfolio's capital growth justifies the loan, but if growth stalls in a flat decade, you are servicing the Lombard loan from income elsewhere. Mike Petry's verdict: a Lombard loan passes questions 1 and 2. Question 3 requires a cash buffer and a repayment plan. Below approximately 500,000 euros in portfolio value, this is manageable debt, not passive debt. The distinction matters. The 3-question takeaway. Before you touch a Lombard loan, answer 3 questions. 1. Does your asset grow? For a broad ETF portfolio, yes. 2. Is the Lombard loan rate below your expected return? At 2 to 3% against 8% historical return, yes. 3. Can the asset pay the Lombard loan itself? This is the honest question. If the answer is not clearly yes, you are managing debt, not leveraging wealth. That is the difference. Elena answered yes to all 3. She borrowed 50,000 euros, kept her portfolio compounding, and paid 1,250 euros per year for the privilege. Thomas answered yes to 1 and 2, but ignored question 3. No cash buffer. Maximum leverage. The margin call cost him the recovery. The Lombard loan is not a trick the wealthy keep secret. It is a financial tool with clear mechanics, clear conditions, and clear failure modes. The tool is not the risk. Using it without answering all 3 questions is: before you borrow a single euro against your portfolio, answer 3 questions. 1. Does it grow? 2. Is the rate below your return? 3. Can it pay for itself? If you cannot answer yes to all 3, wait. Here's the question for the comments. Does your broker offer a Lombard loan or margin investing facility? And would you use it? Drop it below. If this opened a door you did not know existed, subscribe here for more NTM explainers, and watch Mike's full debt trap breakdown on Nobody Told Mike, the framework behind every debt decision. Link below.